A recent survey conducted by NorthWestern Mutual found that the average American thinks that they need about $1.46 million to retire comfortably. This number is up $200,000 from last year's survey and almost $500,000 from 2020's survey. With the average American having less than $100,000 saved for retirement, this can obviously be a very daunting number. But in this video, I'm going to show you just what a $1.5 million retirement looks like as far as your spending capacity, as well as two other cases that I think are a little bit more realistic for most folks out there, retiring on a lot less. Everyone, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. We're a wealth management firm located here in Florida, but we help people all across the country retire with confidence and clarity. Whether or not you actually need $1.5 million to retire, I think depends on four different factors. Number one is how that money is invested and what account types it's invested in. In other words, retirement accounts like 401ks, or is it invested in real estate, etc. Number two is how much you need to or plan to spend in retirement, as well as any other income sources like Social Security, pensions, or rental income. Number three is your retirement age and your life expectancy. In other words, how long you need that money to last for. And number four is whether you're single or married. Your marital status can have a big effect on how much you actually need to retire. Married couples often have dual income from Social Security, whereas single individuals may not need quite as much for spending in retirement. So we'll take a look at how all those factors influence how much you actually need to retire. We're going to use a financial planning software called Income Lab in this video. The Income Lab will show you what your spending capacity is using a Guardrails spending strategy. If you're not familiar, a Guardrails spending strategy is a dynamic spending strategy, which just means you're flexible on your spending each month that increases or decreases depending on the performance of your portfolio. Unlike other traditional retirement spending strategies, Guardrails aims to maximize your spending over your lifetime while still not running the risk of running out of money. So the main purpose of this strategy is to not die with a pile of cash left in the bank that you regret not spending earlier. So this is what we'll call our base case. This is John and Jane. They're both 65 years old. We're going to assume that they're retiring this year in all of these examples. Just a brief overview of their financial situation. Their current assets are going to be the $1.46 million that the average American thinks they need to retire. They also have their home, which is paid off. Again, you can't use that, of course, for income in retirement. And then they have a joint savings account that they won't rely on. That'll be kind of a backup savings account. So their investments are broken down into a joint brokerage account with about $280K, Jane's Roth IRA with about $80,000, John's Roth IRA with about $150,000, Jane's 401k with about $500,000, and John's IRA with about $450,000. So just to show you the breakdown of where that money is at, again, pre-tax accounts, tax-free accounts, and then the taxable bucket here. Their expenses, they expect to be about $60,000 per year. They're basing this solely off of the 4% rule, which says you can, afford to spend about 4% of your portfolio balance each year, which would be $60,000. So we'll also take a look at the other income sources that they have, which would be Social Security. So for Jane and John, we're going to assume, again, this is the base case, that they both get Social Security of $2,500 per month, starting at full retirement age, which is age 67 for them both. So that'll be other income that they have in retirement. We're also going to assume that the asset allocation in each of their accounts is a moderate allocation of about 60-40, and the average annual return net of inflation is about 4.7%. So to see what their spending capacity is, we'll take a look at their dashboard. Once again, Guardrails is a dynamic spending strategy that sets an initial withdrawal rate that's usually higher than the 4% rule, for example. But in exchange for that higher withdrawal rate, you have to be flexible when the market either goes up or down and your portfolio rises or falls as a result. So as you can see, their initial spending capacity on a $1.46 million portfolio is $10,668 per month. So that's over $120,000 per year. Part of their plan, again, is if they hit their upper guardrail, which we can take a look at in more detail here, they're able to increase their spending. Again, the point of that is so that they don't end their life with a big pile of cash in the bank, which is often the case with things like the 4% rule. So if the market hits that, or if their portfolio hits that upper guardrail, they can increase their spending. And conversely, if the market drops significantly, obviously you can see there's a much bigger buffer here. So if the market would have dropped, or if their portfolio would have dropped 22%, which is a pretty big drop for a 60-40 portfolio, they would have to cut their spending only about $500 or so per month until the market recovered. So again, this is the base case, and just to look a little bit further, we will see that their portfolio withdrawals is their sole source of income for the first few years until they start taking Social Security. Once that kicks in, less of it needs to come out of the portfolio, so that is, again, reducing the likelihood of them running out of money. But the main purpose of the case study here is to show that a $1.5 million portfolio can ultimately support about $10,000 or more per month with this strategy, obviously when you include Social Security. So let's look at another example on retiring with much less than that. All right, so for case number 2 here, we have John and Jane at age 67. So they're retiring a little bit later, but they do have considerably less than the initial example. I basically cut all these accounts in half. So instead of retiring with 1.46 million, they have about $730,000 across all of their accounts. We're still going to assume that they're invested moderately at 60-40 and that they want to spend about $5,000 per month. They also have a much lower Social Security benefit. We are going to assume that they both are going to receive $1,800 per month at full retirement age, so down quite a bit from the $2,500 a month in the other example. So using these numbers, I think would apply to a lot more folks out there. So let's take a look to see what their spending capacity is with this type of plan. So by cutting these numbers in half, John and Jane are still able to spend upwards of $6,000 per month, which is over $72,000 per year. Again, fully dependent on how their portfolio does, they could very likely spend more than that. If they hit that upper guardrail, they're pushing upwards of $7,000 per month. And also, if John and Jane in this example find that they are willing to be more flexible to spend more money, they can change their guardrail setting down here. So, for example, they if they're willing to take on a higher chance of adjusting their spending, based on the market, so they can increase their spending to about $6,300 per month. But obviously that lower guardrail is going to be closer, so the market or their portfolio wouldn't have to drop as much for them to see a decrease in spending. But just another setting that you can adjust here using the guardrail strategy. So also, since John and Jane are retiring at age 67 and planning on taking Social Security right away, they don't need quite as much right off the bat from their portfolio, only about $2,600 per month. So as you can see, their Social Security allows them to stretch out their portfolio withdrawals over a much longer period of time. So again, case number 2, $730,000 portfolio, half of what the average American thinks they need, still able to spend with Social Security over $6,200 per month. The last example here will be a single retiree. So for those of you watching who are single or widowed, this one would be more helpful for you. But Jane is 62 in this example, so she's going to hope to retire earlier and on much less. So in this situation, she'll have $500,000 plus that bank account that we had earlier. But basically $140,000 in a brokerage account, which of course would be single name, wouldn't be joint here. Her Roth IRA, and then her 401k with $320,000. We'll also assume that her Social Security in this case is $2,000. Again, she's only going to have one benefit here, so $2,000 is what we'll assume for that. So let's take a look to see your spending capacity in this type of situation. So with $500,000, Jane is still able to spend right around $3,500 per month. Again, in this situation, we are assuming that her house is paid off, so this would be mostly on discretionary expenses. So still a good idea of what you could spend on a $500,000 nest egg as a single individual with that one Social Security benefit. So, and to take it a step further for someone in single Jane's situation here, since she may be a little bit more nervous about retirement, not having a spouse with income, really not sure what the future holds for her. She may be a little bit more nervous and cautious overall, so we can stress test her specific plan to see what would have happened in various financial crashes. So, for example, the global financial crisis in 07-08, we can test her plan to see that starting out, she would have that $3,400 in planned income or so. When the market dropped in 2009, she would have had to take a small pay cut, so she'd have to drop her income temporarily as the market recovered, and then she would eventually hit that upper guardrail and start being able to increase her income again as time went on. So this is a really good way to show you kind of what would have happened if you had retired before these different market crashes and hopefully put Jane's mind at ease a little bit. So obviously each of these case studies was very high level, but it should give you an idea of how much you're able to spend on a given nest egg and a given Social Security benefit. Like I said in the beginning of the video, I think the Americans that answered this survey may be overestimating what they actually need to retire on. I know plenty of people who retire on a lot less than $10,000 per month. With that said, keep in mind that the numbers that we went over for spending capacity are before taxes. We didn't go into any strategies like Roth conversions or which accounts to withdraw from first for the most tax efficient withdrawal sequence. So certainly don't take the information in this video as personalized advice, but more of a guideline for what you could potentially spend and how much you'll need to save for retirement. If you think you could benefit from a personalized retirement income strategy, feel free to reach out to us and schedule an appointment to chat. There's a link in the description below. Thanks for watching, and we'll see you in the next video.